Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On tonight's program, Julia Lee looks at the comeback of tech stocks right now and reveals her latest plays. And then Michael Wayne of Magellan Financial rates 10 tech stocks as tech stock prices are on the rise. And I then reveal the mega double-digit gains the analysts are predicting for those particular stocks. And then poor Rickard tells us if it's too early to believe in tech stocks and the re-rating of those particular stocks. But he also rates BHP and Magellan. And he asks the question, are they buys or not? That's the program. So let's kick off now with Julia Lee of Permanent Invest. Thanks for joining us, Julia.
Great to be here, Pete.
You are what I call a momentum trading fund manager. Correct me if I'm wrong, but you do tend to pick up on investing themes that you think are going to get bigger and better, and you get onto them. And last week we saw tech stocks starting to get a little bit of a comeback. What's your take on the comeback of tech stocks at this point in time?
Sure, I think tech stocks are looking interesting here, and definitely it does look like there was some turning point reached last week. And I guess if we have a look at the macro picture, the main thing that's been on investors' minds that has impacted on tech stocks is interest rates rising, especially in the US. Now, we saw the first interest rate hike coming out of the US in March, so 25 basis points, and the Federal Reserve has really set out a plan in terms of interest rate hikes. So what's priced in this year is 7 interest rate hikes and another 4 next year. And the market's quite comfortable with that now. But the reason for those interest rate hikes is that the US economy is doing very well. And inflation, of course, is an issue. And as an investor, if you're thinking and talking about inflation, then you want to have assets that are going to beat the rate of inflation. Because what inflation does is it eats away at cash, the value of cash. It also eats away at the value of loans. So it's a good time to go out and get a loan at the moment. But really you want investments to beat that inflation to help offset that deterioration in the value of cash. So usually you're looking for high growth companies, which of course have been hit hard in the lead up to the interest rate hike. But I think now that the market's quite comfortable with the interest rate forecast and the environment, it's now time to be looking more at growth stocks. I think in the tech space, there are some interesting companies here. Square, which is listed on our market now, thanks to its takeover of Afterpay, probably has a valuation north of about $200 and it's trading at about 180. So still looking undervalued there. Altium, also there's some strong momentum coming into its business. It prints electric circuit boards, so that one's looking quite good as well. And Xero has been smashed in the year to date so far, so looking like there's some value in that
and
as
so,
well.
Is your thinking then that you're chasing those quality tech companies? Is making a profit an important part of your assessment of a tech company?
Yeah, I mean, in the past it wasn't when interest rates were at 0. It was more about growth. But as interest rates rise, if you don't have any profit and cash flow coming through, then your valuation is going to deteriorate very rapidly in a rising interest rate environment. So it is important to back those more mature companies rather than the startup companies that do have a stable growth outlook as well as profit coming in through the door. So I guess the difference between the mega techs and the speculative space can really be seen here. So look, I think at these type of valuations that we're seeing now, the tech sector is certainly worth putting a little bit of money in. And of course, we heard from China last week that it'd be looking to stabilize its markets. And of course, some of the big tech giants there have been sold off quite severely as well. So not just US tech and Australian tech, but maybe a bit of Chinese tech as well.
You mentioned Square, and Square is a payments company. I've made the point on this program recently that a great company like PayPal went from about $300 down to $100. Payment companies generally have been smashed. Do you think there's probably going to be a gradual reevaluation of the future of payments companies?
Sure. I guess when you're looking at companies in the type of year that we've had, one, you can look at the company fundamentals or what's happening under the hood in terms of the business. And secondly, you can look at the share price. Now, the share price action has been horrible in 2022 so far. But if you have a look at the fundamentals, there are some companies that have exceeded expectations that are showing some strong signs of momentum in terms of what they're doing in the business. And one of those companies is Altium, and Square also in its last results beat expectations as well. So look, Square's I think an interesting one because we often link it to Afterpay, but really it is a payments company. So it is exposed to small and medium enterprises. It also helps get websites off the ground as well. So look, its share price has come down a lot, but in terms of that earnings result, it was actually quite a good earnings result. So here, you know, the fundamentals and the technicals have been saying something different, but now we're seeing the share price playing a bit of catch up. So the two are pointing in the right direction.
Over the years, you've always shown me that you're a chicken when it comes to falling knives. You don't like stocks that you describe as being falling knives. Is Magellan still a falling knife, do you think?
Yeah, I think the reason why I don't like falling knives is that I do like numbers, Pete, and I've gone back in time and I always look at best performers and worst performers. And often you think those companies that are the worst performers are looking relatively cheap. But if you look at historically as a group, they usually underperform not only the best performers on the market, but the market as a whole. So I guess the big question is, you know, does Magellan have a strategy in place to turn around what's caused its underperformance? And so, look, I would prefer to see the seeds of a turnaround in place before I invested in the stock, because I think it's very difficult to pick those turning points. And, you know, if you've got 10 underperforming stocks and you invest in 10 of them, 2 or 3 of them might turn out to be good turnaround plays and the rest just keep on
The reason why I'm asking you this, because a lot of Hamish's old exposure was to tech companies and Chinese companies as well. And both of those seem to be in a much better space, a better space than say a year ago. Like we know Jack Ma is now findable and I think President Xi is probably going to be less aggressive towards his tech companies and tech companies generally seem to be better. Is that at least a good reason to wait to see if Magellan can start rising from these levels?
Yeah, I think that's a really good point, Pete. You've got the actual funds that invest in different investments, and then you have the fund manager. And the fund manager share price has been coming under pressure because of outflows. But in terms of the funds, the outlook is probably looking much better here. So if you were to look at investing in a Magellan fund, certainly the ones with exposure to big tech, I think, are looking better. And if we do see a performance turnaround, then hopefully we start to see those outflows starting to slow down. I think the problem is the way that funds are rated means that if you have instability in terms of management and the board, which we've seen in terms of Magellan, then often those ratings agencies will pull back from recommending those companies. So there's a flow-on effect in getting money in through the door. So I think if you're investing in Magellan MFG, then you're looking for a slowing of the outflows. And if you're investing directly into the funds, then I think certainly it's looking interesting because of those big tech investments as well as those investments.
Thanks for joining us, Julia.
Thanks for having me, Pete.
Well, my next guest is Michael Wayne of Medallion Financial. And I'm interested to see what he's seeing in this tech stock slight rebound we're seeing right now. We know that high interest rates have spooked a lot of people out of the tech stocks, and many have been smashed. And the one I point out often to a lot of the people who've been asking about tech stocks, PayPal was a $300 stock last year. Now it's down around 100. It may well have rebounded last week, not quite sure. I haven't checked that one out. But I do know that Block was up, which of course bought Afterpay when it was called Square. It was up 40% last week, and other ones were significant rises last week. So I'm keen to see if he thinks this is the beginning of a tech re-rotation back into stocks that were also really given a real going over some months ago. Great to see you, mate.
Good to see you, Peter.
Are you having the same sneaky question? You know, is this sort of the change for tech stocks?
I think you've got to sort of keep that in the back of your mind.
Yeah.
you look at the NASDAQ, and then there was about 50% of businesses on average, so down 50%. So
Huge,
it's
isn't it?
huge moves below the surface. The index itself wasn't down as much as that, but there's been a lot of good quality businesses that have come back a long, long way. And it's a very similar situation here in Australia. You look at the Aussie market, the ASX, is down, or was down about 10% at the worst of it. But you take out some of those commodity companies, BHP making up 10% of the index, and there's a lot of high quality companies that have just come back a long way. So I do think that markets tend to get overly negative on the downside, overly optimistic on the upside. And I think it makes sense to be trying to look at some of those quality names, which on a 2, 3, 4 year view, you can have a lot of confidence in.
And what is also interesting is that I can't see how the Ukraine-Russian peace possibility talks with those. It had to be linked to Jerome Powell and what he said and therefore implied about interest rates that created the opportunity for tech to start making a move in the positive direction.
Yeah, I mean, you saw on the day, the announcement initially came out, markets were a bit weaker, but then as the day went on, ever since then, we've seen this pretty significant rally. Don't get me wrong, I wouldn't be surprised that once this little euphoria phase passes that we get a bit of a retracement.
Yeah.
But I think it just gives the market a bit of confidence that how they've priced in these rate rises is somewhat accurate, at least for now.
Yeah.
I think the market's expecting 7 rate rises in the US. If information and data comes out, which leads the market to change their forecasts, say they expect 8, 9 interest rate rises, then you'll see, I think, tech companies again come under pressure.
Yeah.
Likewise, if we start to see inflation taper off for whatever reason, the oil price come back, that might see people par their expectations to 5 or 6 rate rises, in which case tech could continue to rally quite strongly.
And that's the interesting thing, is that you've got the possibility that he doesn't need to be as aggressive because maybe commodity prices do come off the boil, oil prices come off the boil. And also, it seems to me that the market is respecting the strength and the growth of the US economy more now than they were some time ago.
Well, that's right, and that's the comments coming out of the Fed. They weren't very concerned about a recession at all, whereas
They
only
ruled
a
it
couple
out,
of
didn't
weeks
they?
ago, they pretty much ruled it out. And a couple of weeks ago, you're getting headlines again about stagflation, which is basically a situation where inflation is roaring away, interest rates are forced to go up in a situation where the economy is slowing significantly. And he kind of ruled that scenario out, which gave a lot of people confidence to at least start dipping their toe back into the water with some of these more growth-orientated names.
Yeah, and for someone like you, you do look around for value, and some of these companies have been over smashed. And I'm going to run through a lot of well-known Aussie names. I'll see what you think, and I'll also say what the analysts are saying about these companies. And I think some people will be surprised that some of the better quality ones are not really loved that much by the analysts, because they actually have been loved.
Yeah.
And WiseTech's a case. I'll jump straight to WiseTech, because WiseTech has done pretty well, and the analysts think there's like a 9% fall in its price, but he has done well compared to the others that were in that wax group.
The wax group. I mean, WiseTech's probably been the better one in the last 12, 18 months. It's continued to report extremely well, exceeding expectations. And the fact is, people have probably herded into that name out of some of the other wax type businesses. So I think on a relative basis, there are better alternatives than WiseTech, although it's been going from strength to strength, I think, in the last couple of years.
It's been a great reward. It hasn't been oversold or anything.
That's right.
Yeah. Okay, let's start with I think is like the blue chip of tech stocks, Xero.
Yes.
And I believe that they're setting up a headquarters in Hawthorne, Melbourne this week as well. A press release came out. I like Xero, and I think the market's gone too far in the opposite direction. What do you think about Xero?
Yeah, Xero's one we've actually been buying over the last week or so.
Yeah.
Anything, sub $100, we think on a long-term basis will be fairly attractive. We see these like wild moves with Xero a few times in recent years.
They're profit takers, aren't they?
I'm not sure what it is. It could be the bots or whatever it may be. You'll probably have to take a survey of everyone that's bought or sold it. But it's a very high quality business. They've turned profitable in the last sort of 12, 18 months. They continue to grow very, very nicely over in the UK and in the US, and continue to chip away in Australia and New Zealand. So we think that's a business that's made the transition to a profit-making company that will continue to to do quite well.
Yeah, analysts think 17% upside. Let's go to another quality one, NextDC.
Yeah, NextDC, this isn't one that we've held for a while. It was pretty extreme valuations there for some time. Did report very well though in February, like a lot of companies did. So that's a business that we don't own, we haven't been buying it, but you could definitely put it on your watch list. But look, they continue to build more and more data centers, their capacity continues to increase, the demand for their products remains and is only expected to continue growing.
It's kind of like a blue chip company, you expect to shoot the lights out, but they won't let you down over time.
I'll have it as a hold, but it's not one we've been buying, so I can't give it a buy.
All right, here's the one I think you introduced me to is Megaport. Now, Bevan Slattery, who I then interviewed after I talked to you, he has recently reduced his exposure. He still owns 5% of the company. Yeah. Well, what did you think when you heard that story?
Well, it forced the share price down about 8 or 9% on Friday. He still owns a big chunk. Yeah. He gave a commitment for what it's worth to hold the remaining stock for at least 6 months or more. You have to remember someone like Bevan invested very, very early on. He's done incredibly well out of that position, so it makes sense from
his family might like him to realise some profit.
Or diversify away from having too much exposure to one business. But this is a company again that reported extremely well in February. We would have a preference for Megaport over NextDC at this stage. And when you consider Megaport was $20 not that long ago, $13 at the moment, and the business fundamentally is probably improved, then we're confident. And this is a company, again, that's meant to be turning profitable in the next 6 months or so.
Yeah, and I like the idea of Megaport is that as the world gets more and more back to normal, people are going to need to use the kind of services it provides.
Yeah, 100%. They call it a network as a service. Basically, you can tap in to access these different networks whenever you need the capacity. And it's a very attractive product. They've got great relationships with the Amazons, Googles of this world. So we think that that's a very good business.
Okay, another one who I think has been over smash, and I talk about it a lot because I've lost some money on this one, but it's also part of my Zeep group of stocks, Tyro. Tyro seems to be smashed, but payments companies have been smashed. I guess I'm hopeful that the uptick from Block will probably roll into all the payments companies.
Yeah, look, I mean, I must admit I haven't been following Tyro too closely in the last sort of 6 months or so. I see they had a decent move on the market today. And again, it could be some of that bargain hunting, but Tyro's been a good business now for a long period of time. It might not be growing as quickly as some of those other tech names, but in terms of the technology, it's very good quality. They've been targeting a lot of small, medium-sized businesses, pretty much the area which the banks don't focus on. They had a big exposure to hospitality, which had been struggling, obviously due to COVID. But that's starting to recover again, and that will help with the number of volume and transactions going through their merchants. So we'll have a hold on Tyro, but it's not one that we've been buying.
Yeah. So Megaport, by the way, analysts think 38% upside. Tyro, analysts think 63% upside. Another one in my Zeep stock, Zip, it's up today as well, I noticed. And it's obviously a payments company. The share price got unbelievably low, 55% upside, the analysts think.
Yeah, Zip's a tough one. It's sort of been left behind in the coverage by some of these other names, but Zip has been doing a lot. They obviously had the big acquisition in the US. They've recently announced something as well in that same space.
Sezzle was
Sezzle was the most recent update. So they continue to be proactive, looking to build scale. We've never been a holder of Zip. It's tempting to look at it at these levels, but you could argue that when it was at $10 or whatever it was, that was an extreme valuation. That was when the whole sector was running hot.
$160.
Afterpay was 150 and 160. So Zip around these levels probably feels more justified. And that considering its growth path, we think that these levels are probably more realistic.
Well, what I've given a lot of chances to is Appen. Didn't like the last story about Facebook and all that sort of stuff. Analysts think a 0.5% upside. Well, what's your view on Appen nowadays?
Appen's one we held probably 4 or 5 years ago. We decided to sell out because there was a lot of coverage around the fact that although it is categorised as a tech business, it is very capital and labour intensive.
Labour intensive,
And the problem always we thought for Appen was once they got to a certain size, maybe the companies that they're servicing wouldn't require their services as much anymore. They might bring all these things in-house. So the way to think about Appen's business model you think about a self-driving vehicle, they've got to go and label stop signs. So you have thousands and thousands of images with red stop signs, and there's humans actually putting into the computer that that's actually a stop sign. So you can see how it is quite labour intensive, and it doesn't have the dynamics that many other tech businesses have.
Yeah.
And it's had, I've lost count, probably 5, 6, 7 profit misses or downgrades in the last couple of years. So no point from my standpoint to
And I
jump in.
think they're also having problems with the fact that there's accusations that their work is, in a sense, affecting consumers. Like they're working out what consumers do, and a lot of the tech companies have been accused of using that information inappropriately. And I think that being linked to that hasn't helped them. Next one is Elmo Software. Analysts think 110% upside. This company seems to do well, but the market never gets too excited about.
Yeah, it's one I've been sort of following and pretty closely for probably 3-4 years. It's had moments where it's looked like it's about to take off, and then for whatever reason has come back, and it's been range bound now for a number of years. And the problem is, I don't know what's causing that, because the company reports very well. They set expectations low. They always sort of exceed just slightly. When you look at the multiple it trades on relative to a zero, although they're not like-for-like businesses 100%, there are similarities there. It trades on very low multiples. So you've got a situation where the share price has just been oscillating sideways, yet the business has been improving. So I think if you've got some patience over time, this one will come to fruition. But for the moment, it just seems unloved for whatever reason.
And it's interesting you make the comparison with Xero, because they actually complement Xero because they're heavily into payroll. But they probably are suffering the fact that Xero share price is down, so therefore its share price is down. And another thing I'd throw in about these guys is that they have an interesting acquisition in Breathe. And Breathe is like where they take their medium-sized business model to a small business model.
Yeah.
And I guess that's going to be an interesting testing point for where this company goes.
Well, that's right. I mean, Breathe was a UK-based company, but has a lot of similarities between the two, and it gives them access to new markets and slightly different modules as well. So one to keep an eye on, although if the markets do take off, I don't necessarily think Elmo is going to be the one that jumps first. There might be others.
Yeah, might get in the tailwind. EML's had a problem with the Central Bank of Ireland. It also has taken off and then been brought back by those sorts of things. What do you think about EML?
It's tough because they went and did this large-scale acquisition in Ireland. They raised a lot of money to do that. They even maybe took on some debt from memory. And it's hard because what they were expecting to get out of that acquisition, the revenue numbers, customer numbers, just hasn't been able to come to fruition. Effectively, it was sort of anti-money laundering type activity that the central bank was
the company they took over, wasn't it really?
That's right. So that there might be limits on the value they can place on some of these gift cards, and that would seriously affect the value of that acquisition. So from mine, I think there's too much negativity around that. And when you've had so many good names pull back such a long way, I don't think you need to be chasing those with other issues.
And that's the reason why I'm actually running through a whole list of interesting names, and you can prioritise the one you want to chase. One that you'll always like is AD8, Ordinate. The analysts think 47% upside. Have you changed your view on Ordinate?
No, there's been nothing really to change the view from a long-term standpoint. They've had some issues in the short term with supply chains. They're just struggling to meet their order book.
Stuff coming out of China, not coming out of China.
Not coming out, and they're trying to find workarounds, which takes a bit of time. But I think the positive side is there's definitely demand momentum in that company. It's just that they're struggling to meet that. But it's also like the way that the business operates, there's a bit of a lag between when they sign up a new customer or a customer embeds their product to when they actually get paid and see the revenue come through from that. So at the moment you look at the balance sheet, it doesn't look that amazing in terms of revenue growth, but very quickly over time, as their protocol is embedded in more and more electronics, they're going to see that revenue kick up. So we still like it. We think it's very good quality, and the fact that it's sort of basically a monopoly in that space at the moment, growing many multiples times the nearest competitor, we think it's worth persisting with.
Its nearest competitor is?
The nearest competitor is, I don't actually know.
Well, didn't you? You make the point that this is like a private version of Bluetooth.
It's effectively, the thing is, it's kind of a new concept. This is why there's no real like for like competitor in that. if you think about the old cords that you put together your different electronics, it removes the needs for those cords, and it's like a stronger version of Bluetooth, which allows different pieces of equipment to communicate.
So are you saying that some businesses wouldn't use Bluetooth, even though Bluetooth works nice for the consumer?
That's right.
If you're doing a big concert, for example, and you wanted all your people around the grounds to be connected, is Audinate the kind of technology that they would use?
That's right. So different speakers on either side of the field can all be linked up without the need for all those cords, and it's a lot more powerful than Bluetooth to use.
But this is a new concept, so it's going to take time to grow. But and I guess its first spoke to share prices were those excitable tech heads who realise how great this is, but the market becomes a bit of a realist.
So if you think about like a Yamaha or Bang & Olufsen or Bose or whatever it is, they are the companies that build the electronics, and they now are embedding this Audinate protocol into their systems, which will allow them. So it's all new electronics coming to market will include this. A lot of the older ones don't. But over time, as these things continue to come to market, that will continue to boost demand for them. They're also moving into the digital video space as well, whereas in the past it's all been audio.
That's fairly popular nowadays.
Well, that's right. That's another huge growth area.
Yeah. That's Michael Wayne from Magellan Financial. Well, I wanted to catch up with Paul Rickard about some of the interesting developments in the market, in particular the fact that we've seen tech stocks improving. Last week they improved. Nasdaq was up 8%, as I said earlier in the program. And today, tech stocks are also up again. So Paul, do you think this is a re-rotation back into tech stocks, or is it a sneak preview of what might happen?
Yeah, look, I think it's more a sneak preview, Peter. I think the correction was largely what we've seen, a big correction in tech stocks. This is just a bit of the rebound. It got too overdone. A bit stronger in the US, Peter. There's been more of a rebound in the US than there is here in Australia.
They probably sell off harder, did they?
Well, I don't know.
Some of our companies have gone harder.
Some of our companies have gone pretty far.
Yeah.
I suspect we're not yet ready to see a rotation back into tech. We're going to get some corrections, right? Things went too far, they always do. Markets always overshoot both on the upside and the downside. I think you're going to, what support you are seeing will be more on the quality stocks. So I would think in this environment, stick to the quality. I think it's too early yet to sort of.
All is forgiven.
I don't think all is forgiven with tech. I mean, you've got to remember that by and large, the thing that really upset the market in the first place was that they, higher interest rates.
Yeah.
And although you can argue about, present value of, future earnings and the rest of the stuff, that there still was a logical reason why tech stocks came down. And US bond rates are now higher today than they were a month ago or 3 months ago or 6 months ago. So there's a reason. So they're almost at their highs. So there's a reason why tech stocks got sold off. Valuations were over the top. And so that reason hasn't yet gone away. So I suspect there's a bit more pain to come.
Okay, so this would be an interesting question for a lot of our viewers, Paul. And you made the reference about how rising interest rates affects the present value and all that sort of stuff. But also they are called growth companies, aren't they? And was a bit of the concern in the US that interest rates rising quickly could really choke off growth, and that wasn't good. But Jerome Powell was sort of more positive on growth, wasn't he?
Yeah, look, there's a quid pro quo. I mean, you've got to say the whole thing with Ukraine has changed the situation again because. Forecast for world growth have now come down a bit, and the US Fed has reduced its growth forecast for the US, which is going to make it a bit harder. And if trade gets constrained, I dare say a lot of the tech stocks were selling into Russia. A lot of their software and some of the other services.
Even had employees there in both countries.
Yeah, and so they've had to pull back there. So that's going to the environment's not as conducive as it was a few months ago. So I think that's if interest rates go too high, that's going to, the Federal Reserve is going to be worried about constricting growth too much. So, but I don't think we're out of the woods yet. Yeah. I think the re-rotation may come back later in the year.
Yeah, to me, it's a sneak preview, and people who buy tech now just have to be patient. But I think one day there will be a big, for the reason you pointed out. A company like PayPal was 300, went down to 107 or something like that. That seems like an excessive sell-off. And by the way, also because in America, they don't have the same kind of stocks that we have here that are doing well during the war. Financials not so much, but certainly mining and energy have been good for us. A lot of our fund managers wouldn't be prepared to get out of them now to go into tech.
Yeah, no, I think that's right. I mean, there's only so many dollars that can go into the market. Professional fund managers are really worried about, how they go against their peers.
Yeah.
One of the reasons that there's a bit of herd mentality is you can't afford to take too much of a position against the market. So if all the money is going into financials and resources, because they are benefiting from some of the geopolitical instability and other factors, it's a very high risk strategy to go and put a lot of money into tech with a lot of money going into the major sectors. So
Yep.
I think that's another reason, Pete.
Okay, you've been a great fan of BHP and not as much Rio, but they've done well together. Is it too late to buy BHP?
Look, I don't. I mean, I wrote a couple of weeks ago when they got up to near $50. I still think you've got to be a long BHP. Wait for a bit of a pullback. We had some. I think this is a market to be at least index weight. So BHP's weight in the market at the moment is about 11%. Most investors are well under that.
Yeah.
I think this is the time you have to play this. I think you'd be, again, like all these, this market's going to give us opportunities. Things just don't run away straight away, and we see that. So I think BHP is still reasonable value.
Okay, and what about Fortescue? It hasn't been doing as well. What's going on there? I'd rather be in BHP simply because the quality of the minerals is higher. Fortescue, I think, is getting a bit of green backlash?
Anti-green backlash. I think the market's worried whether a lot of the money's profits might get diverted into some of the so-called green initiatives. I think that's, I'm not sure that Twiggy's got the market quite on side with the pace he wants to deliver. Plus their grade of material is lower, and that's subject to margin risk. So I think it's been more a fact that we've seen a bit of change in Fortescue and people don't know quite how much money is going to come back to shareholders, how much is going to be invested in these other initiatives. And where there's doubt, investors tend to say, well, I don't need to be in something there's doubt, there are alternatives.
Okay. Is it time to punt on Magellan Financial?
Well, I think that's a gutsy call still. And when I say gutsy, it is, you can't but argue it's still the falling knife, right? So has Magellan bottomed?
Yeah.
The issue for Magellan is fundamentally about investment performance, right? And while you've got investment performance has been under par, you've had some big institutional outflows, you've got planners, some planners who are moving their clients out of Magellan. That all takes time, but it's happening. And when you're getting funds outflow, obviously that will impact future earnings. And that's why you've seen the share price continue to be punished. And the market got a bit excited the other day when they announced $5 billion worth of funds outflow. So the secret of turning Magellan around is you want to see improved investment performance. Now, we only get data on that every month. I haven't seen anything to suggest that the investment performance is back on top. Now, I think that the move getting Brett back was a good.
Brett or Chris?
Sorry, Chris.
You always get Brett.
Yeah, I don't know why I get
Brett.
Brett. I get the two confused. But Chris
Mackay.
Mackay back
Yeah.
was the right step.
Yeah.
Some of his investments may have done a bit better last week because we know that they had quite a big exposure in China. We've seen some of the Chinese major Chinese tech stocks rally, and also we know that he looked at some of their exposure in some of the big US consumer names or consumer discretionary names, people like Meta and with Facebook obviously, and they've also done all right. So it could well be the performance is getting back on track. But you have no data yet to say that. So
it's for the thrill seekers still.
I think Magellan is still in look, there's no doubt it's fundamentally cheap. There's no doubt that it's got a very deep, loyal retail funds client base who invest in their funds. And it's had a great long-term performance, but it's fundamentally struggled the last couple of years because of investment performance. And I think you need to see data. So I'm wary of the falling knife, Pete, and say, look, I want to see, when I see their funds management performance start to get back on track, then I think you buy Magellan. But, this could be the low today, so who knows just how that plays out.
Yeah, and I asked Paul that because Paul is a very cautious man. If he said, yes, it's time to buy, it would be time to buy. But good advice. It still is in that very tricky area. It's for the thrill seekers at this point in time. You make the fair point that a lot of the stuff that they invest in is starting to look better, so it might show up in their returns soon. But this is a company that's under a lot of pressure and they have to do a lot to change their attitude. One last thing before we go, mate. Talking about tech stocks, we had Eleanor Swanston from Firetrail on the program some months ago when she tipped Megaport. And Megaport, of course, was her selection at the SON conference, Hearts and Minds conference. But then we learnt that one of the big shareholders, Bevan Slattery, sold out a big chunk of his investment. He had 12, it went down to 5%. It's still a big holding in the company. So I've just talked to her this morning, and she made the point that they still like Megaport. They were buyers of the stock as well. So those people out there who might have been worried about their investment in Megaport, a big supporter was Eleanor Swanston. She still is, and she makes the point that Bevan Slattery still holds a lot in the company.
Yeah, and I think that's worth noting. I think maybe if I could just throw something to you, Pete. I think one of the things that people are now going to start to focus on the next few weeks is electoral risk.
Yeah.
Okay. And look, I think there's a whole lot of data. You know, you're going to talk about this at some stage around. It's not necessarily a bad thing. But you've got to now be bait. But I think as an investor, you're now going to be assuming there's going to be a change of government.
Yeah,
right?
I think so too.
Right? And that could make our markets just a little tricky over the next couple of weeks, notwithstanding a budget next Tuesday. So
yeah, that's right. And I think specific companies could be negatively affected. History shows that the overall market is not all that badly affected by an election, a lot less than we expect. And there's often a rebound no matter who wins. And that's probably the interesting thing. But certainly some companies could be in trouble once the Labor Party's policies are revealed, and even the budget could as well.
Well, maybe we don't actually find out much because it seems like they're not going to say a lot, Pete. But look, this may be something down the track. But I just caution, the market. I think people have been a bit complacent about the electoral issue, and it's not to say that it will necessarily be bad longer term. But now you've got to say there's a high probability that. Anthony Albanese is going to be the next Prime Minister. Yeah. Okay, the polls could be wrong, but I think that argument is weak. Yeah. And South Australia was absolutely spot on. Yeah. Voted exactly as the polls said, and the polls don't look good, and this is a huge thing. So I would be assuming a change of government, and I think investors need to think that through. So we could have an interesting sort of 6 to 8 weeks, notwithstanding positive leads in the US, whatever's happening, where our market just isn't ready to rock and roll. So,
and I should prepare voters out there for something that could be really unusual. I actually met the new Labor Premier 2 weeks ago when I did a speech in Adelaide for the Master Builders Association, and he's a very intelligent, and you can see why he's one kind of guy. But apparently, I was told by one of his fellow MPs that one of the big turning points in the whole polls was when he took his shirt off. So wait for Albo, the new and improved and much skinnier Albo could whip off the shirt sometime. Apparently, it had a very big impact on the polls. That's Paul Rickard from the Switzer Report. And that's the show for tonight. And don't forget, we're back on Thursday. And if you want to get more insights into the sort of stocks that we like right now, have a look at the Switzer Report at switzerreport.com.au. Once again, thanks for joining us. See you on Thursday.